Welcome to Brain on Books YouTube channel. We are embarking on a really deep dive today into the core principles of wealth building. We're extracting the most potent and practical financial wisdom from Nick Maggiuli's definitive guide, Just Keep Buying.
It's great to be here. Yeah, we've tried to synthesize all the key stuff from the book, the essential data, some findings that might seem a bit counterintuitive at first, and the actual strategies. We've laid them out into what we hope is a clear, actionable roadmap for you.
Think of this as your shortcut, maybe. Your way to understand how to navigate the markets successfully, but hopefully without all the usual stress and noise.
Exactly.
Our mission today for you, our listener, is really clear. We want to move beyond the fear and, frankly, the confusion that often paralyzes people, especially new or maybe tentative investors. We aim to equip you with the strategic certainty you need to build wealth, make sure your money is working harder than you are, and ultimately secure a stable, independent future.
And what we really appreciate about the core philosophy of Just Keep Buying is its relentless simplicity. It just cuts through all the noise, the market gurus, the daily financial headlines. The idea is basically to consistently commit capital to a broad, diversified portfolio. And crucially, maintaining that discipline no matter what the market is doing, whether headlines are screaming panic or, irrational exuberance.
It sounds almost too easy.
Mm-hmm.
Like, just treat investing like an automated bill payment, something non-negotiable in your monthly finances.
Precisely. And the great thing is the infrastructure is finally there to really support this approach now.
Right.
We've got commission-free trading, incredibly low-cost index funds, easy access to hundreds of diversified assets globally.
Right.
So the strategy effectively eliminates the need for any kind of insider knowledge or trying to achieve perfect market timing or doing endless, exhausting research. It's really a system focused on commitment over trying to be perfect.
Okay, let's unpack this then. Let's start with the fundamental question. Why? Why is it so critical that we start investing today, not next year, not waiting for some mythical, perfect moment? The book outlines 3 really compelling reasons. Think of them as the pillars of financial stability.
Yeah, we can call them the 3 anchors, maybe. First, securing your future. Second, defending against that unseen tax inflation. And third, the really crucial conversion of your, let's say, temporary efforts into permanent wealth.
Okay, starting with the first one. Probably the most obvious, but maybe the most neglected. Saving for the future. We all know retirement is inevitable, right? At a time when we might not want to or even be able to work. But people often struggle to prioritize that, 70-year-old self over their immediate desires today.
That really is the core psychological hurdle, isn't it? That disconnect between our present self and our future self, our current energy levels, this feeling of almost infinite time ahead. It makes the need for passive income seem so distant, so abstract. But the research in this area is actually fascinating.
Yeah, this is where the psychology gets really sharp. Think about that research where participants were shown digitally aged photos of themselves, like a visual projection of their future financial self. That immediate, personalized glimpse of old age, it suddenly made the future feel tangible, immediate, not just some far-off concept.
And the result was measurable, quantifiable. Those participants invested, on average, 2% more into their long-term retirement accounts compared to the control group, just from seeing a picture. It transformed an abstract future need into a much more urgent present problem. And it also aligns perfectly with another finding. People who are saving for those really long-term essential goals, like retirement or maybe an emergency fund, they demonstrate far greater consistency and save more compared to those focused only on short-term discretionary things.
Like a vacation or a down payment for a house.
Exactly. Things that feel more immediate but aren't necessarily essential for long-term survival. So investing really needs to be seen as an immediate necessity, not just some luxury you'll get around to later.
Okay, so that's a powerful psychological nudge. But if that wasn't compelling enough, the second reason is this invisible force constantly attacking your wealth: inflation. Can you break down why just holding cash or saving in a standard savings account is actually financially punitive in the long run?
Yeah, inflation it's the great quiet destroyer of purchasing power. Think of it as an involuntary, invisible tax that you pay every single year. Your salary might go up nominally, right? The number looks bigger. But if the cost of housing, energy, education, groceries, if those rise faster, then your real buying power, what you can actually get for your money, diminishes.
So it's the difference between the number on your statement and what that number can actually buy.
Precisely. That distinction between nominal returns and real returns after factoring in inflation is absolutely vital.
And what does that erosion actually look like over time? We often hear about 2% inflation, and it sounds, well, manageable. Doesn't seem like a big deal.
That small percentage masks immense long-term damage. It really does. At a relatively mild 2% annual inflation rate, which is often the target for central banks, your money loses half its purchasing power in about 35 years.
Half. So a dollar today buys 50 cents worth of stuff when you retire.
Roughly, yes. And if inflation picks up, say it averages 5%, which isn't historically unprecedented, that loss of half its value happens in a devastatingly short 14 years.
Wow, okay. That really puts into perspective why merely saving, just keeping money in low-interest accounts, is fundamentally a losing proposition over the long term.
It is. You're essentially running on a treadmill, maybe even slipping backwards slowly.
So the solution has to be growth that outpaces this invisible tax, right?
Exactly. You absolutely must hold assets that are expected to provide positive real returns after inflation. Just consider the historical contrast the book highlights. If you invested $1 in long-term U.S. Treasury bonds way back in 1926, by 2020, it grew to approximately $200.
Okay, that's growth. Seems okay.
It is growth, but after taxes and inflation, it barely keeps you ahead. It's more wealth preservation than wealth creation. However, that same $1 invested in a broad, diversified basket of U.S. stocks over the exact same period, it grew to over $10,000.
$10,000.
Yes.
Compared to 200.
Yes. The stock market's historical capacity to deliver significant real returns well above inflation, is precisely why it forms the backbone of nearly every successful long-term financial plan. It's the engine of growth.
That 50-fold difference.
Yeah.
That's just staggering and really underscores the point. Okay, so that brings us to the third powerful reason from the book, this idea of converting human capital into financial capital.
Yeah, this is a slightly more sophisticated way of looking at your working life, but it's really important. Your human capital is essentially the economic value derived from your time, your knowledge, your skills. It's your ability to earn an income. Now, you can continually improve your knowledge and skills, right? But you absolutely cannot increase your available time, and your physical energy, well, it naturally declines as you age.
So your current job, your ability to work, is kind of like a temporary asset. It's fueled by limited energy and finite time. And the goal is to convert the value generated by that temporary asset into something permanent, something that generates passive income even when you stop working.
That conversion is the magic. It's the power of compounding in action. Consider the example of someone earning, say, $50,000 a year for 40 years. They consistently save 15% of that. And let's assume they earn a conservative 6% annual return on those savings. Early on, in the first decade or so, their wealth growth is mostly driven by their savings contributions, the money they're actively putting in.
Right, the pile grows because they keep adding to it.
Exactly. But over time, especially in the later decades, the last 10, 15, 20 years, compound interest really takes over. The growth on the existing money starts to outpace the new money being added. The financial capital itself starts generating more income than the person's human capital ever did. That's the crossover point.
And that guarantees income long after that $50,000 paycheck stops coming in. That's financial independence.
That's the goal.
And as you make that transition, moving from relying on your paycheck, your human capital, to relying on your portfolio, your financial capital, you face something critical we should probably mention. Sequence of returns risk.
Oh, absolutely. That's a huge one, especially as you approach retirement. Sequence of returns risk is basically the danger posed by experiencing poor market returns right at the beginning of your withdrawal phase.
So if the market crashes just as you stop working.
Precisely. If you're forced to sell assets when prices are low just to cover your living expenses, you severely deplete your principal. It makes it incredibly difficult for your portfolio to recover later on.
Ouch.
So a successful conversion strategy, building up enough financial capital before you retire, helps minimize this risk. It gives you a buffer, allowing you to potentially ride out that early volatility without having to sell low.
Okay, so we've established the why. The reasons investing is non-negotiable. Now let's talk about the where. We know the money needs to be invested, not just saved. But where does the book recommend actually placing it? What kind of assets?
Right. And the book is really adamant about this. There is no single magical strategy or asset class that guarantees wealth. Anyone promising that is, well, probably selling something. The objective is flexibility and, crucially, diversification. It's about constructing a robust portfolio made up of multiple different types of income-producing assets.
So spreading the risk.
Spreading the risk, achieving balance, and focusing on consistent buying over many, many years. Decades, really.
Okay, let's start with what most people think of first. stocks, or equities, often called the undisputed heavyweight champion of long-term wealth creation.
And for good reason. Stocks represent ownership. When you buy a share of, say, Apple or a broad market index, you own a tiny fractional slice of those companies and their future profits. Now, they are volatile, yes, we absolutely have to acknowledge that up front, but historically they have proven to be the most reliable engine for capturing global economic expansion and innovation.
That resilience is key, isn't it? You mentioned a study earlier.
Yeah, the study covering 16 countries from 1900 to 2006 is remarkable. Think about what happened in that period. 2 world wars, the Great Depression, hyperinflation in some places, numerous recessions. And yet, despite all that turmoil, every single one of those 16 countries showed positive, long-term, real returns from stocks after inflation.
That's incredible resilience under fire. The U.S. averaged something like 6.8% annual real return over that century.
That's right. And another key benefit, especially with index funds, is the lack of maintenance required. Once you buy a broad index fund, you're effectively outsourcing the management. You're trusting the engine of capitalism, spread across hundreds or thousands of companies.
But that trust requires some serious nerves of steel sometimes, doesn't it? You have to accept the inherent volatility.
You absolutely do. Historically, the data shows prices can drop by 50% roughly twice a century. Those are the big ones. But drops of 30%, those tend to happen roughly every 4 years or so on average. And smaller 10% corrections, almost every other year.
Those can feel like a personal attack on your savings when they happen.
They really can. But understanding that they are normal, expected market behavior is crucial. The investor who sees these events not as a reason to panic sell, but maybe even as an opportunity, and simply continues to buy, allowing time to do the heavy lifting. That's the investor who ultimately succeeds.
Which leads directly to the recommended strategy, right? It's almost never about trying to pick the next single stock winner, the next Tesla or Amazon.
No, the odds are heavily stacked against that. The solution the book champions is index funds and exchange-traded funds, ETFs. They provide instant, low-cost diversification across hundreds or even thousands of companies. Think like an S&P 500 fund or even broader, a total world index fund. You buy the whole haystack instead of searching for the needle.
Okay, makes sense. Now moving on to the traditional counterweight in a balanced portfolio. Bonds or fixed income.
Right. Bonds are fundamentally different from stocks. You're not buying ownership. You're essentially lending money.
Yeah.
Typically to a government or a large high-quality corporation.
And in return for that loan,
You receive fixed interest payments, called coupons, at regular intervals until the bond matures, at which point the original principal amount is repaid to you.
bonds are often seen as, well, a bit boring compared to stocks, but they serve a really essential stabilizing function in a portfolio, don't they?
They absolutely do, and their stability or perceived stability is tied directly to their risk profile. We often talk about U.S. Treasury bonds because the risk of the U.S. government defaulting is considered extremely low. They can, after all, print money if needed.
But bonds aren't completely risk-free, are they? We need to talk about the primary risks involved.
Definitely not risk-free. The main risks associated with bonds, especially in the current environment, are duration risk and interest rate risk.
Okay, what does that mean for our listener in practical terms?
So, duration risk measures how sensitive a bond's price is to changes in prevailing interest rates. When central banks raise interest rates like they've been doing to fight inflation, the price of existing bonds, which pay those older, lower fixed coupons, tends to fall. Why? Because new bonds are being issued with higher yields, making the old ones less attractive.
So your existing bond is worth less on the open market.
Exactly. And bonds with longer maturities, longer duration, are much more sensitive to these rate hikes. Their prices fall more sharply. This is why bonds, while generally stable during stock market crashes, can actually lose value, sometimes significantly, when inflation is high and interest rates are rising.
Okay, so they aren't a perfect safe haven in all conditions, but their main role remains diversification and stability.
Yes, their primary role is providing liquidity and that crucial countercyclical stability. They tend to behave differently from stocks, especially during panics.
And that countercyclical nature was really put to the test recently, wasn't it?
Oh, absolutely. Look back at March 2020, the rapid COVID crash. The stock market plummeted incredibly fast. An all-stock portfolio would have suffered enormous paper losses in just a few weeks. Very scary stuff. However, a diversified portfolio, let's say a classic 60% stocks and 40% bonds mix, held up far better.
How so?
Well, the stock portion crashed, yes, but the bond allocation provided that crucial ballast. It didn't necessarily shoot up in value, but crucially, it didn't crash alongside the stocks. It provided the investor with stable assets they could potentially sell to cover expenses if needed, or ideally, use that stability as dry powder to buy more stocks while they were on sale at the bottom. That's rebalancing in action.
Got it. Okay, moving on from financial assets to tangible ones, let's talk about real estate, specifically direct ownership first. The big appeal here seems to be the power of leverage.
Leverage is absolutely the key driver of returns in direct real estate, but it is definitely a double-edged sword. You typically use a relatively small amount of your own money, the down payment, say $100,000, to secure control of a much larger asset, perhaps a $500,000 property. The rest is borrowed. Now, if that property value increases by, say, $100,000 to $600,000, a 20% rise in asset value, your initial $100,000 equity investment has effectively doubled in value, a 100% return before costs.
So the loan magnifies the appreciation. That sounds great.
It sounds great when prices are going up, but that amplification works exactly in reverse during a downturn. A 20% drop in property value could wipe out your entire initial investment.
Ouch. And besides the amplified risk, the sheer amount of effort and hassle involved is immense, isn't it?
Oh, absolutely. Leverage amplifies both gains and losses. Plus, direct property ownership is highly illiquid. You can't just sell a bedroom instantly if you need cash. And it carries immense concentrated risk. All your eggs are in one property, one location, plus the management duties. You are the landlord. You're dealing with tenants, toilets, termites, taxes, vacancies, local regulations. It's practically a part-time job.
Yeah, not passive income in the truest sense, which is why many people prefer the more hands-off approach using REITs, real estate investment trusts.
Exactly. REITs offer a way to invest in real estate without being a landlord. These are essentially companies that own, operate, or finance income-generating real estate across a range of property sectors. Think shopping malls, apartment complexes, office buildings, data centers, warehouses, etc. And the key thing is they are required by law, in most jurisdictions, to distribute the vast majority, typically 90% of their taxable income to shareholders in the form of dividends.
And they trade on stock exchanges, right?
Yeah.
So they're much more liquid?
Much more liquid, yes. You can buy and sell shares easily, just like a stock. That's a huge advantage over direct ownership.
But we need to flag a key difference here for listeners, especially regarding taxes. It's not quite the same as standard stock dividends, is it?
That's a really critical point, especially for a deep dive audience. Unlike most qualified dividends from regular stocks, which often get preferential tax treatment, REIT dividends are typically taxed as ordinary income.
Which usually means a higher tax rate for most people.
Often, yes. So while REITs can provide excellent income yields and diversification, especially perhaps in times of high inflation where rents can rise, you need to factor in that tax difference. And importantly, despite being tied to real estate, they still behave a lot like stocks. They are generally considered a risk asset, meaning they tend to fall sharply during deep market crashes alongside equities.
So diversification within REITs is also important.
Absolutely. Again, the recommendation is generally broad REIT index funds, covering various sectors and geographies, not trying to pick the winning regional apartment complex REIT yourself. Spread the risk.
Okay, that's helpful. Let's just zoom out for a second and look at the typical comparative returns the book presents across these main asset classes. Just understand the rough risk-reward spectrum.
Sure. So looking at long-term historical averages, and these are just averages, remember, stocks, broadly diversified, tend to provide somewhere in the range of 8% to 10% compounded annual returns over long periods. Bonds, our stability anchor, typically offer much lower returns, maybe 2% to 4% on average, often just keeping pace with or slightly beating inflation. REITs, being kind of a hybrid equity-like asset with high dividend payouts, often land somewhere between stocks and maybe slightly higher, say 10% to 12% average returns. And direct real estate, largely due to that leverage factor and the owner's effort involved, frequently shows historical returns in the 12% to 15% range, though with much higher specific risks and illiquidity.
Okay. And what about opportunities that promise even higher growth than that?
Yeah, those definitely exist, but they come with significantly higher risk and usually require more active involvement. We're talking things like private equity, maybe starting your own successful small business, or angel investing in early-stage startups. These are incredibly high risk, very illiquid. You might not see your money for years, if ever, and often requires substantial capital and direct human effort or expertise. But yes, if successful, they can potentially generate annualized returns of 20%, 25%, or even more.
So the pattern is clear. Higher potential return generally means higher concentrated risk, lower liquidity, and more active involvement needed.
That's the trade-off, exactly. Stick to the foundational assets, stocks, bonds, maybe some REITs. unless you are fully prepared financially and mentally for that extra layer of risk and effort.
And just to be crystal clear, we should probably restate that things often hyped as investments like gold, collectibles, artwork, or most cryptocurrencies are generally not foundational wealth-building tools in the way the book defines them.
Right, because they typically don't provide reliable, ongoing income or cash flow. Their value relies almost entirely on someone else being willing to pay more for them later. That makes them primarily speculative assets, not investments based on underlying economic productivity. It's a gamble on price fluctuation, not a commitment to long-term growth.
Okay, that distinction between income-producing, foundational assets and purely speculative ones leads us perfectly into the core strategy that Mijuli champions throughout the book, using index funds.
Yeah.
This really means abandoning the dream, or maybe the temptation, of picking individual stocks yourself. Let's tackle the financial argument against active stock picking first, because the data is pretty overwhelming, isn't it?
It is genuinely sobering when you look at it objectively. Even the world's most sophisticated, highly educated, highly compensated professionals, we're talking about mutual fund managers, hedge fund analysts, institutional traders with vast resources, they consistently struggle to beat simple market benchmarks like the S&P 500 over meaningful periods.
Yeah, the stat you often hear is that something like nearly 75% of actively managed large-cap funds fail to outperform their passive benchmark index over a 5-year period.
That's right. And if you extend that time frame out to 10 or 15 years, the percentage that underperforms often climbs even higher, sometimes over 90%.
So if the professionals people paid millions to try and win this game can't do it consistently, what makes the average individual investor think they can beat the odds?
Exactly. It's a question of humility, really. And this is where the why behind the index fund strategy really hits home. It connects to a concept in statistics called power law distribution, or sometimes the fat tail phenomenon in market returns. Remember that shocking research we mentioned covering the U.S. stock market from 1926 to 2016?
The one about the 4%.
Yes.
Yeah.
It found that only the top 4% of all listed U.S. stocks during that entire 90-year period were responsible for all of the market's overall outperformance compared to simply holding low-risk treasury bills.
Wait, let me get this straight. Only 4% generated all the excess return. What about the other 96%?
The other 96% of stocks, in aggregate, essentially matched or underperformed the return of safe treasury bills. Many failed completely. Many just treaded water.
So if you're trying to pick just, say, 5 or 10 individual stocks for your portfolio, what does that imply?
It means the entire game is incredibly skewed against you. You are essentially betting your financial future on your ability to identify, in advance, and hold on to one or more of those extremely rare, massive outlier winners, the next Microsoft, the next Apple, the next Amazon. If you miss just one or two of those mega winners over your investing lifetime, your overall portfolio performance is likely to fall dramatically behind the simple market index.
Because the index automatically owns all the stocks, including those huge winners.
Precisely. Index funds, by their very design, ensure you own 100% of those winners instantly, effortlessly, and at incredibly low cost. You capture the entire market return, good and bad, without needing to predict the future. It's the ultimate diversification against the risk of missing out on those crucial few stocks that drive most of the gains.
And the risk isn't just about picking the wrong new company. It's also about the inevitable decline of today's giants, isn't it? The mortality of companies.
Oh, absolutely. Creative destruction is relentless in capitalism. You mentioned the Dow Jones Industrial Average composition from March 1920. Of those original 20 companies, titans of industry back then, none of them are still in the index today.
None? Wow.
They've been acquired, gone bankrupt, or simply faded into irrelevance and were replaced. What's dominant and popular now almost certainly won't be the leader in 50 years. Maybe not even 20.
So picking a winner for the next 5 years is hard enough.
Picking one for 50 years, it's essentially impossible. It forces you into a constant cycle of research, reevaluation, buying, selling, trying to time exits and entries, all while incurring trading costs and taxes along the way. It's exhausting.
Which really moves us from the purely financial argument to what I find is maybe an even more powerful case against individual stock picking.
Yeah.
The existential argument,
Yeah.
the impact on your sanity, your time, your life.
Yeah, it raises that fundamental question. How can you, as an individual investor, genuinely distinguish skill from pure luck in your results, especially in the short term? When you have a single great trade, maybe a stock doubles quickly. Was that because of your superior analysis that you can reliably replicate, or did you just get lucky? Maybe it caught a wave of social media hype or an unexpected takeover bid?
And it takes years, maybe decades, to really know the difference.
Exactly. And those years are often spent in a state of high stress uncertainty, constantly second-guessing yourself.
And the emotional drain must be immense. Monitoring quarterly earnings reports, obsessively watching the news cycle for your specific companies, agonizing over every 1% dip in a single stock you own.
It becomes a significant psychological burden. It consumes mental energy that could arguably be better spent on your actual human capital, your career, your skills, your family, your health, your life outside of market watching.
So the index fund approach is almost like a financial strategy disguised as a mental health strategy.
That's a great way to put it. By spreading your risk across the entire economy or large segments of it, the fate of any single company becomes almost irrelevant to your long-term outcome. A single bankruptcy won't ruin you. You secure market-matching, consistent returns, which, as we saw, beats most professionals anyway, without the constant stress and emotional burnout. You automate the process, set it, fund it regularly, rebalance periodically, and then you get on with living your life.
Okay, so we've established the why investing is crucial, the where, diversified assets, and the how, primarily index funds. Now we need to tackle the critical question of when. And the book's title, Just Keep Buying, kind of gives away the punchline here, doesn't it? But let's dive into the supporting data and reasoning.
It really does encapsulate the core message on timing. If you look at the stock market's history, despite all the crashes and crises, the long-term trajectory is relentlessly upward. It reflects overall economic growth and innovation over time. While volatility is absolutely a feature, not a bug, the market rises far more often than it falls. From the depths of the Great Depression, through world wars, Cold War scares, oil shocks, tech bubbles bursting, financial crises, pandemics, the market has always eventually recovered and reached new highs.
So the implication is clear.
The implication is that the best time to start investing was yesterday. The second best time is now. You want to give your money the maximum possible time to benefit from the power of compounding growth and shield its purchasing power from that insidious crawl of inflation we talked about. Delay is costly.
Okay, that makes sense for starting out. But this leads to that eternal investor debate.
Yeah.
What if you receive a significant chunk of cash all at once? Maybe an inheritance, a bonus, or selling a business. Do you invest it all immediately, the lump sum approach? Or do you ease it in slowly over time, dollar cost averaging, or DCA?
Yes, the lump sum versus DCA debate. It comes up all the time. Statistically speaking, looking purely at historical market data over long periods, if you came into, say, $1 million, investing the full amount up front, the lump sum method, is generally the superior strategy for maximizing your long-term wealth growth.
Why is that?
Because, as we just said, the market tends to go up more often than it goes down, lifts 75% of the time historically. So any money you hold back in cash while dollar cost averaging is, statistically speaking, likely missing out on potential market gains during that waiting period. Plus, it's losing value to inflation while it sits on the sidelines.
Okay, statistically, lump sum wins. But I have to push back on that a little because psychologically, investing a huge lump sum feels terrifying for most people, doesn't it? What if you're incredibly unlucky? What if you dump that entire million in and then, bam, the market crashes 30% the very next month? The regret would be immense. Isn't the psychological comfort of DCA worth potentially sacrificing some statistical optimality for many investors, especially newer ones?
That is absolutely the real trade-off. You've hit the nail on the head. DCA provides significant emotional safety by minimizing the risk of that worst possible timing scenario. It dramatically reduces potential regret. However, the data consistently confirms that, on average, trying to time your entry point perfectly or spreading it out too long via DCA generally costs more in foregone gains than it saves by avoiding the worst entry points.
So is there a middle ground or a way to make lump sum less scary?
Yes. The key is to mitigate the risk of the lump sum investment, not by delaying entry, but through smart asset allocation from day one. Meaning, instead of putting that entire hypothetical million into an aggressive 100% stock portfolio all at once, you use that lump sum to immediately establish your target diversified portfolio. So you invest the full amount on day one, but perhaps into a 60% stock, 40% bond allocation, or whatever mix is appropriate for your risk tolerance and timeline.
So the bonds act as an immediate shock absorber if the market does drop right after you invest.
Precisely. The bond portion provides that immediate ballast and reduces the volatility of the overall portfolio, making a sudden drop less painful. Meanwhile, the stock portion gets straight to work, benefiting from maximum time in the market for compounding.
That makes a lot of sense. You get the statistical benefit of immediate investment, but with a built-in safety net through diversification.
Exactly. It's a way to capture most of the upside potential while significantly cushioning the potential downside. Far better than slowly drip-feeding the money over months or even years while inflation eats away at the cash portion. Ultimately, the market trends upwards over time. Delaying your full entry is usually the higher cost in the long run. Don't wait for the stars to align perfectly. Start now, but start smart with diversification. Hashtag tag VB. Managing volatility and crisis.
Okay, no realistic discussion about investing, especially long-term investing in stocks, is complete without squarely addressing the fear of volatility, those gut-wrenching market drops. And the message from the book here is actually quite counterintuitive for many people. The biggest risk in investing isn't actually experiencing volatility. It's trying too hard to avoid risk altogether.
That's right. Long-term success fundamentally demands accepting that unpredictable drops are part of the deal. They are the price of admission for earning those higher long-term returns that stocks offer. Trying to completely avoid any market movement, any downturn, inevitably means avoiding the long-term upward growth as well. You can't have one without the other.
And the book uses a really clever thought experiment to illustrate just how expensive this fear, this avoidance of volatility can be. The genie thought experiment.
Yeah, it's a great illustration. Imagine a magical genie appears at the start of each year, and this genie tells you with perfect accuracy what the maximum intra-year drawdown, the largest peak-to-trough drop, will be in the S&P 500 index for the upcoming 12 months.
Okay, so perfect foresight on the year's biggest dip. If you had that, you'd surely get incredibly rich, right? You could just jump out before the drop and jump back in after.
You'd think so, but here's the catch. Let's look at the historical data from 1950 to 2020. The average maximum intra-year drop for the S&P 500 during that period was about 13.7%. Drops happen every year. Now, suppose you decided, using your genie's perfect information, that you were a hyper-conservative investor. You only wanted to be invested in the stock market during years when the genie guaranteed the maximum drop would be less than 5%.
Okay, so only staying in during the really calm years. What happens?
Well, you'd find yourself sitting on the sidelines, out of the market most of the time. Because drops of 5% or more are extremely common, almost an annual occurrence, in fact, and the calculated result. By attempting to perfectly dodge even relatively small volatility, that hypothetical investor would have ended up with approximately 90% less wealth over that 70-year period compared to the investor who simply bought the index and held on tight through every single dip, big or small.
90% less, just by trying to avoid drops under 5%. Wow.
It vividly demonstrates the point. Avoiding risk isn't protecting wealth. It's guaranteeing a significantly smaller future portfolio because you miss out on the majority of the upward growth, which often happens surprisingly quickly after those dips.
And, crucially, since there is no genie in reality.
Right. There's no way to reliably predict whether the next drop will be a minor 5% blip or a major 40% crash.
So the only truly effective solution isn't trying to time these unpredictable events, but rather using the diversification we already discussed.
Exactly. Building a portfolio with an appropriate mix of different asset classes, like stocks and bonds, helps manage the impact of the volatility. It smooths the ride, making it psychologically easier to stay invested rather than attempting the impossible task of eliminating risk entirely.
This mindset becomes absolutely critical when you face a genuine market crisis.
That's when discipline truly meets opportunity. As the famous quote attributed to Baron Rothschild goes, "The time to buy is when there's blood in the streets." Crises, driven by extreme fear and panic selling, push asset prices down, often far below their intrinsic value. These moments are essentially limited-time sales for investors who have the courage and the capital to act.
And for investors who do have cash available, or perhaps stable assets like bonds they can sell, buying during the crash can lead to dramatically higher returns down the road. There's some exponential math involved in recovery, isn't there?
The math of recovery is essential to grasp. A small loss, say 10%, only requires an 11.1% gain to get back to break-even. That feels manageable. But as the loss gets steeper, the required recovery gain explodes exponentially. A 20% loss needs a 25% gain. The 30% loss needs about a 43% gain. And a 50% loss, losing half your money, requires a massive 100% gain just to get back to where you started.
So the deeper the fall, the harder the climb back.
Precisely. Which is exactly why buying near the bottom, even if it feels terrifying at the time, sets the stage for capturing those enormous percentage returns during the inevitable recovery phase. You're buying low, so the subsequent climb back to normal represents a huge gain on your purchase price.
And we have some powerful recent examples of this in action.
We certainly do. Think back again to March 23, 2020. The S&P 500 index hit its pandemic low, down about 33% from its peak just weeks earlier. Based on that recovery math, the market needed roughly a 50% gain just to return to its previous high.
And investors who showed the courage to buy around that bottom.
They saw that 50% gain materialize in just 6 remarkable months, an incredible return for those who leaned into the fear instead of running from it.
And looking back further historically,
The historical data is consistently compelling. Analyzing market drawdowns between 1920 and 2020, studies show that money invested during any period where the market was down 30% or more resulted in less than a 10% chance of earning less than 5% annually over the subsequent long term. The odds shifted dramatically in your favor. In fact, if you invested when the market was down 50% or more, your historical odds of earning over 25% annualized returns in the following years were actually greater than 50%.
wow. So the lesson seems to be try to reframe the crash mentally. It's not necessarily a personal disaster if you're diversified and have a long time frame. It's potentially a window of extreme opportunity.
That's the ideal mindset, yes. But, and this is a crucial but, we must emphasize consistency over trying to be a hero and perfectly time the bottom. Even if you were incredibly unlucky, maybe you invested a lump sum at the absolute peak of the Japanese stock market bubble in December 1989, right before its multi-decade stagnation.
Yeah, the classic nightmare scenario.
Even then, the power of consistent buying provides a significant shield. If you had simply dollar cost averaged, say, the equivalent of $1 a day into the Japanese market, starting from 1980 and continuing right through 2020, buying all the way down and during the stagnation, you would have still ended up with a small, positive overall return.
Even through the lost decades.
Even through that, because your consistent buying meant you acquired many more shares when prices were incredibly low, averaging down your cost basis significantly. So the ultimate goal isn't to perfectly time the bottom of the crash, which is impossible anyway. The goal is simply to keep buying consistently through thick and thin according to your plan. That's how you ensure you participate in the recovery whenever it comes.
Okay, we've covered buying, holding, navigating volatility.
Right.
Now we have to address what might be the hardest part of the entire investment cycle for many people: selling. This seems to be where human emotions like fear of loss when markets are down, or greed for just a little more gain when markets are up, most frequently sabotage an otherwise sound long-term plan.
Selling is definitely emotionally charged. The book stresses that you absolutely must avoid selling impulsively based on fear or greed. Instead, you should only sell for specific, predefined, disciplined reasons.
Takes the emotion out of it if you have rules decided in advance.
Exactly. Define the parameters for selling before you're in the heat of the moment. The book outlines essentially 3 approved, logical reasons to sell the assets you've worked so hard to accumulate over the years.
Okay, let's start with the first one, which is more about portfolio maintenance. Selling to rebalance your portfolio.
Right. Rebalancing simply means periodically adjusting your holdings to bring your portfolio back to its original target asset allocation. For example, that classic 60% stocks, 40% bonds mix we talked about. Over time, because different asset classes grow at different rates, your portfolio will naturally drift away from that target. Historically, stocks have tended to grow faster than bonds.
So if you started with 60-40 and just left it completely untouched for, say, 30 years.
It could easily naturally drift to become 75% stocks, 85%, maybe even 90-95% stocks, depending on market performance.
Which means the level of risk you're taking is now dramatically higher than what you originally intended when you set up that 60-40 allocation. You're no longer invested in the portfolio you actually designed for your risk tolerance.
Correct. You've inadvertently ended up with a much more aggressive, much more volatile portfolio than you might be comfortable with, especially as you get closer to needing the money. So the primary goal of rebalancing isn't actually to maximize returns. In fact, some studies suggest a portfolio that never rebalances might slightly outperform statistically over the very long run, purely due to that higher unmanaged stock exposure.
Interesting. So why do it then?
The true value of rebalancing is risk control. It's about protecting your downside and managing volatility, especially as your portfolio grows larger and a major drop becomes potentially more devastating to your plans. It keeps your risk exposure aligned with your intentions. Annual rebalancing is generally considered a practical frequency.
And for investors who are still in their accumulation phase, meaning they're still actively contributing new money each month or year, there's a clever way to rebalance without actually having to sell their winning assets and trigger taxes, right?
Yes, that's the strategy often called rebalancing with contributions or rebalancing without selling. Instead of selling the assets that have grown too large, usually stocks,
Yeah.
you simply direct all your new investment contributions towards the lagging asset class, often bonds or maybe international stocks, until your desired target allocation is restored.
So you buy more of what's underweight.
Exactly. You effectively rebalance by adding strategically. This avoids triggering capital gains taxes on your winners, allowing them to continue compounding fully. It's generally the optimal strategy until you actually start needing to withdraw money in retirement.
Okay, that makes sense. What's the second disciplined reason to sell?
The second reason is to deliberately exit or reduce a highly concentrated position. A common example of this is when employees accumulate a large amount of their company's stock, perhaps through stock options or grants as part of their compensation. It might end up being a huge percentage of their total net worth.
Right, having like 50% or more of your wealth tied up in the stock of the company you also work for, that sounds risky.
It is a massive, often underappreciated risk. Your income source, your job, and a huge chunk of your savings are both tied to the fate of that single company. If that company runs into trouble, you could face a devastating double whammy, potential job loss, and a simultaneous collapse in your portfolio value.
Not a good situation.
Definitely not. So the smart play here is proactive risk mitigation. The strategy is to gradually sell off predetermined portions of that concentrated stock position over time, maybe over several years.
And use the proceeds to diversify.
Exactly. Use the proceeds to buy those low-cost diversified index funds we talked about, spreading your risk across the broader market.
And it's important to be strategic about what you do with those gains from selling the company's stock too, isn't it?
Absolutely. Using the proceeds from selling a concentrated stock position to pay off a guaranteed obligation like a high-interest mortgage, student loans, or other significant debt is almost always a wise move, mathematically and psychologically.
Even if the company's stock might grow faster than the interest rate on the debt.
Even then, because the debt payoff provides a guaranteed rate of return equal to the interest rate you're no longer paying. Future stock growth, no matter how promising it seems, is only a possibility, never a guarantee. Reducing debt locks in a benefit and reduces overall financial fragility.
And you mentioned selling gradually.
Yes, for a couple of reasons. First, selling a large block all at once could potentially trigger a very large tax bill, especially if it's appreciated significantly. Spreading it out might allow you to manage the tax impact, perhaps taking advantage of lower long-term capital gains rates if you've held the stock for over a year. Second, psychologically, it can be easier to part with it incrementally. But the key is to have a plan and stick to it, consistently working towards lowering that dangerous concentration over time. Remember, individual stocks, even great ones, often underperform indexes long-term.
Okay. Gradual planned reduction of concentrated risk.
Yeah.
Makes sense. Finally, the third, and arguably the most important and fulfilling reason to sell, to actually use the money to enjoy the fruits of your labor and fund the life you want.
This is it. This is the whole point, isn't it? The successful completion of the entire investment cycle, selling assets to fund a comfortable and secure retirement, to pay for your children's or grandchildren's education, to cover necessary healthcare expenses, or maybe to finally take that round-the-world trip you've always dreamed of. That is the ultimate purpose of investing. It signifies victory, not failure.
It feels like sometimes people get caught up in just accumulating more, seeing the number go up, and they forget why they started investing in the first place. The book touches beautifully on the economic concept of diminishing marginal utility here, right?
It does, and it's such a crucial concept for well-being. Diminishing marginal utility basically means that the additional happiness or satisfaction, the utility you get from each extra dollar, decreases as you become wealthier. The utility, the real-life improvement gained from increasing your net worth from, say, $0 to $1 million is absolutely enormous. It buys security, freedom from financial stress, options, basic comforts. It's life-changing.
But the jump from $1 million to $2 million,
The additional happiness gained from that second million is significantly smaller than the first. And the jump from, say, $10 million to $20 million. The incremental utility is likely very small indeed for most people. Once your core financial needs are met and your defined retirement goals are securely funded, relentlessly accumulating further wealth often adds very little measurable joy or well-being to your actual lived experience.
so the real goal isn't just maximizing the number on the screen indefinitely.
No, the real goal should be maximizing the utility of the money you have, using it to create the life you've dreamed of, to support the people you care about, to have experiences. That's not failing at investing. That's succeeding at life, enabled by your investments. #Tag7. Conclusion and final thought.
Okay, so to wrap up this really comprehensive deep dive into the core ideas of just keep buying, we've essentially identified a set of core financial behaviors and mindsets that are designed to systematically create wealth over the long term, not just maintain it.
That's a good summary. First, really internalizing why investing is essential. It's a non-negotiable step to secure your future against the unknowns, to fight the guaranteed erosion of inflation, and to successfully convert your finite human labor into potentially infinite financial capital.
Second, the importance of where you invest. Building a robust, diversified portfolio using foundational, income-producing asset classes like stocks, bonds, and maybe some real estate exposure, always respecting the unique risk and reward profile of each.
Third, the how. For most people, eliminating the stress, the cost, and the statistical long odds of trying to pick individual stocks. Instead, embracing the simple, elegant, consistent power of low-cost, broadly diversified index funds and ETFs. Buy the market.
Fourth, the critical dimension of when. Recognizing that the clock is always ticking. Time is the single greatest multiplier in investing. So start immediately, because decades of data show that time in the market consistently beats trying to time the market perfectly.
Fifth, mentally preparing for and accepting volatility as a permanent, unavoidable feature of the market landscape. Understanding that attempts to dodge every single dip will almost certainly cost you far more in foregone growth than simply staying invested and riding out the downturns within a diversified plan.
Sixth, learning to view those inevitable market crises not just as threats, but as potential, albeit scary, limited-time opportunities. Buying when fear is highest historically positions you for maximum potential returns during the eventual inevitable recovery phase. Keep buying.
And finally, seventh, adhering to a strict, emotionless discipline around selling. Only selling for those three specific rational reasons. Selling to rebalance and manage risk, selling to prudently exit a dangerous concentration, or ultimately selling to finally fund and truly enjoy the life you built this portfolio to enable.
It seems like we lack the tools to perfectly predict the future, right? We don't have a time machine. We don't have that magic genie.
We don't.
But what we do have are these timeless, simple principles drawn not from guesswork, but from decades and decades of actual market history and data.
Exactly. Financial success, as outlined in this philosophy, doesn't require genius-level intellect or complex algorithms. It primarily requires discipline, patience, and the commitment to one powerful, consistent decision. It really all starts and continues when you simply decide to just keep buying.
If you want to listen to a detailed summary of more finance-related books, then hit that subscribe button now.